Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's late afternoon, Wednesday, February 4th, and the title of today's audio blog is The Big One Has Started. Protect Yourself Now. Now, before I get to today's extremely important discussion, of which I changed the title whilst writing at 3:45 p.m. Eastern Standard Time due to the terrifying Greece news that emerged, I wanted to note an important anniversary I'm celebrating this week. Yes, exactly 10 years ago today, I left Wall Street for good, after 16 years as a compliance officer, bond trader, and stock analyst, ending with a 6-year stint as an oilfield services, drilling, and equipment analyst at Solomon Smith Barney. Ironically, in my final months at Solomon, in 2004 and 2005, the firm elected to shed the Solomon moniker due to the stigma involved with countless scandals such as WorldCom, Enron, and Treasury bond bidding fraud. Why do I say such a change was ironic, you ask? Well, because it was replaced by the name of our corporate parent, Citigroup, which not only has become infamous for its role in repealing the Glass-Steagall Act, but as one of the most corrupt and incompetent banks ever, has the honor of being the most bailed out firm in global history. Anyway, it's hard to believe that world is so far in my past, given how much energy, no pun intended, and enthusiasm I put into it. Starting with my first internship in college at Payne Webber in 1989, when I cold called strangers trying to sell CDs, that is, when they used to have actual yields, I was as dedicated to my craft then as I am now, and from 96 to 2005 was as passionate about oil and gas as I am now about gold and silver. Of course, when our business peaked with the global economy and financial markets at the turn of the century, my interest strayed elsewhere. I kid you not, the process of having no clue about precious metals to become fully invested took but weeks, starting with a hot tip from my Solomon broker about Newmont mining stock in May 2002. From then until I left Solomon in February 2005, my passion for oil gradually waned and for gold and silver soared. Throughout that time, I was 100% invested in mining stocks and easily generated the biggest gains of my investing career. Whilst commuting to Manhattan, I printed out every article I could find, starting with Richard Russell, Jim Sinclair, and Bill Murphy. And by the time I left Solomon, had already made a name for myself as a regular GATA contributor, which, by the way, Bill Holter had already been for some time. For the next 2 years, the only work I did was consulting for junior mining companies, which even then had no money, but paid richly in stock options, or if you were lucky, restricted stock. Until the TSX Venture Exchange, i.e. the Vancouver Exchange, permanently peaked in May 2007, which coincidentally was when I moved from my lifelong home of New York to Colorado, I made more money holding junior stocks than I had working in 15 years on Wall Street. However, all that restricted stock was still restricted, and none of those options were meaningfully above their strike prices. And if I hadn't used some of the equity from that time to purchase my house, nearly all of it would have been lost in the subsequent mining stock crash. By early 2008, when I took a job as investment relations officer of a mining company, the sector was already in the process of dying of capital strangulation, and this despite strong gold and silver prices. Less than a year later, the 2008 financial crisis hit, and if it weren't for doubling down on a stock called Silverstone Resources, which was eventually bought by Silver Wheaton at the equivalent of $5 a share, I probably wouldn't be here today, but rather a permanent victim of the gold cartel. Still, the losses were horrible, but at least I'm still standing. However, once the post-2008 rebound in miners peaked, in early 2011, at levels well below the 2007 peak, it was all downhill for mining stocks, perhaps forever. By the end of 2010, my company was nearly out of cash, so I took a job at the leading U.S. investor relations consultant to junior miners, just before the collapse that continues today commenced. By the spring of 2011, I had sold my last mining stock, never to return, and put all the proceeds into physical gold and silver. And thankfully, in October 2011, I was afforded the opportunity to join Miles Franklin. Unfortunately, dollar price gold prices had peaked just 1 month before, making my nearly 3.5 years here a difficult uphill battle. However, I still consider it my dream job and couldn't be happier with the people I work with or correspond with via the Miles Franklin blog. As you can see, my 24/7 war with the gold cartel has gone unabated for nearly 13 years, and as frustrating as it can be, seemingly more so each day, nothing makes me happier or fulfilled than to spread the word of financial and economic truth. And hopefully this brief synopsis of my metamorphosis from mainstream Wall Street to internet blogger gives you an insight of who I am, at least professionally. I have literally lived an investment lifetime in a decade, which, by the way, was the original title of this audio blog, and will continue to devote every ounce of my being to helping protect you from what's coming. That said, I have numerous items to get to before the ugly news that just hit the tape, i.e., the ECB will no longer accept Greek bonds as collateral, in effect cutting off funding to the Greek banking system a full 4 weeks before the February 28th deadline for renegotiating a new bailout scheme. And to think, earlier this week we were being fed propaganda of how well the talks were going, despite Syriza's leaders pretty much telling the Troika to go to hell. Yes, they proposed a debt swap agreement. However, it had as much chance of being accepted as the Bulls trading Michael Jordan for a minor leaguer, which is probably why everyone from the Germans to the ECB laughed at it. I'm not kidding when I say the big one is here, as trust me, today's news is no trial balloon. Instead, it is a blatant act of aggression, as just a week since Syriza took power, the very fate of Europe is in the balance, which, by the way, is exactly what the Miles Franklin blog predicted. Anyway, it's Wednesday just after the close. I'll get back to the Greek drama in a second, which, by the way, has got gold surging and the euro plunging as I speak. Not to mention crude oil, which at $48.50 per barrel has nearly round-tripped the entire past 48 hours of manipulated gains, falling from $54 a barrel just 24 hours ago. To that end, I found it ironic that Zero Hedge noted how oil had surged in its last hour of trading for the past 4 trading days. You know, the sort of Hail Mary rally I've been discussing regarding essentially all favored markets for years, starting, of course, with the Dow Jones Propaganda Average. No, Zero Hedge can't see that the Dow has been propelled by the same dead ringer algorithm essentially every day for 5 years, or that cartel gold and silver rates cannot be more predictable. But yes, the world's best market sleuths have figured out the powers that be's latest desperation strategy, i.e. to try to paper over the hideously oversupplied physical oil market, as exemplified by today's multi-decade inventory high, just as they attempt to paper over the equally undersupplied gold and silver market. Oh well, at least Zero Hedge is on the right team. Yes, a typical day in the early stages of the end game, in which invariably all manner of horrible headlines bombard us from the second we awaken till our head hits the pillow. And even then, today's 24/7 world doesn't allow us a break, at least until the weekend. And for anyone that remembers 2008 and 2009, weekends were no respite either, as the powers that be were continually forced to make earth-shattering decisions, like bailouts, nationalizations, and bail-ins, whilst the rest of us tried to relax. Trust us, those days are coming again, and likely much sooner than you can imagine. Today alone, we started with yet another surprise easing from the People's Bank of China, which in reducing bank reserve requirements by 0.5% created the potential for $600 billion of capital to be injected into the economy. Unfortunately, it won't, as history's largest real estate construction and shadow banking bubble is collapsing as we speak. Clearly, the lesson of the Fed, ECB, and Bank of Japan hasn't been learned, as banks will simply reinvest the freed funds into government-supported financial markets, until inevitably they collapse. And the scariest thing is that all central banks are doing the same thing, and then some, in desperately trying to delay the inevitable collapse their own actions created. China is now the 15th nation since year-end to either cut rates, reserve requirements, or in the case of Singapore, overtly devalue its currency. Just yesterday it was India and Australia, and late last week Russia and Singapore. And as noted last week, nothing could be more terrifying or counterproductive than easing monetary policy when your currency is already in free fall, which is exactly what is occurring in nearly all these cases. Or in Denmark and Switzerland's case, lowering rates that are already negative in a desperate attempt to destroy whatever misconceived notion of safe haven status their currencies still have. To that end, rumor has it, the Swiss National Bank, fresh from one of the greatest failures in central banking history, is unofficially instituting a new euro franc peg at 1.05, which undoubtedly, especially when the Greece crisis catalyzes into the reawakening of the pigs I wrote of yesterday, causes the euro to again collapse into oblivion. Yes, the final currency war is raging in full force, which is why I am 1,000% confident the big one has arrived. Nearly a year ago, I predicted essentially all Western sovereign yields would plunge towards zero as investors front-run QE to infinity. However, I now believe they will all go negative, as clearly the lunacy Denmark and Switzerland are engaging in will cause other central banks to retaliate in kind. This was what I wrote of in yesterday's NERP versus Gold Part 3, the death knell of fiat currency. Heck, we even saw our first corporate bond trade with a negative yield today. Not surprisingly, the Swiss company Nestle. Ultimately, global fear will accelerate exponentially, and likely, despite the inevitable Federal Reserve launch of QE4, the dollar's foreign exchange value will rise equally rapidly. Not against real items of value, of course, like gold and silver, but against less liquid currencies, which will hyperinflate first. Thus, sovereign bonds will likely continue to rally hard, that is, until hyperinflation inevitably comes to town. Last night, the Baltic Dry Index hit a 28-year low, well below the 2008 financial crisis lows, and just 5% from the all-time low registered in 1986. U.S. railroad freight rates, too, are in free fall, lest anyone still believes America can somehow decouple with the world. It can, of course, which is why this week's consumer spending and factory order data was steeply negative, even if Island of Lies diffusion indices still claim we're in expansion mode. Like today's ISM non-manufacturing PI, which seasonally adjusted the weakest new order data since the 2008 crisis to a solidly positive number. Then again, the same fraud was perpetrated in last year's first quarter, when despite negative 2.2% GDP, most diffusion indices were reported to be positive. To that end, I simply can't wait for this year's first quarter GDP data, which care of negative retail sales, durable good, and factory order growth, let alone massive oil and gas capex reductions, should be strongly negative no matter what adjustments are applied. And no, healthcare spending is not economic growth, despite the fact that BEA includes it as such. Only the production of items of value should be considered as such. But as I wrote last month, all economic data are now lies, which recently have become so egregious, even Pinocchio himself would blush. Which leads me to my favorite of all the Island of Lies data, unemployment. Suffice to say, I don't need to spend more time here discussing the idiocies of BLS employment reporting. Simply ask the CEO of the Gallup Survey Company, who yesterday claimed the reported 5.6% unemployment rate is pure fraud. Yes, the chronically incompetent ADP company reported today that January payrolls rose by 219,000, which despite being lower than expected, clearly depicted respectable growth, even if not enough to keep up with population growth. Let alone last week's comedy of a jobless claims number, depicting the lowest number of jobless claims since April 2000, i.e. the aforementioned peak of the global economy, as well as the highest inflation-adjusted equity prices of our lifetimes. Look, we all know such data is cooked beyond comprehension. Like assuming positive birth-death jobs when small company formation is at an all-time low and small company death at an all-time high. However, there's clearly more at play here, starting, of course, that today's average job doesn't resemble those of yore. Today, you can work 10 hours at McDonald's and the BLS will consider you employed. And if you're lucky enough to actually have a full-time job, you're being paid far less on an inflation-adjusted basis than in decades. And as for the plunging jobless claims, and this as energy-related claims explode, my guess is that so many people are now 1099 consultants as opposed to W-2 employees is a big part of it. In other words, if your employer wants to consider you a consultant in order to avoid payroll taxes and shortly the Obamacare health insurance mandate, you literally cannot apply for unemployment. And thus, aside from outright accounting fraud, major structural changes are occurring in the labor market that cause gross distortions of employment data. To that end, we have yet another BLS BS employment number on Friday, which, whether the headline data is worse or better than expected, will, as always, be exposed to the fraud it is by simply looking at its internals, as well as the words of the Fed governors themselves. such as Minneapolis Fed President Narayana Kocherlakota, who just yesterday said, quote, raising the target range for the Fed's funds rate in 2015 would further retard the pace of the slow recovery in inflation. Yes, the slow recovery in inflation we all so fear, which according to central bankers requires QE to infinity, negative interest rates, and for all intents and purposes, unlimited money printing. As for this week's, quote, markets, I frankly don't even want to speak of them. It has become so nauseating to watch. As discussed in last week's The Last to Go, the relentless propping of the Dow and suppression of paper, gold, and silver prices has reached unprecedented levels. Even a moderately intelligent 10-year-old could probably realize this by now, and we assure you major central banks like those in China and Russia surely do. Not that anyone cares much about the Dow Jones propaganda average anymore, as exemplified by CNBC's record low ratings amidst record high stock prices. However, until the PPT can no longer support it, and conversely the cartel hold down precious metal prices, at least some semblance of normalcy will remain. How much longer that will be, no one knows, but clearly the title of today's audioblog gives an indication of my thinking. Which brings me to the horrifying news that emerged just as the New York trading day was coming to an end, i.e., the ECB blocking additional funding to Greek banks. In other words, despite a supposed hard deadline of February 28th for the new Greek government to renegotiate its expiring bailout agreement, the ECB has already fired a depth charge at Alexis Tsipras' Syriza party. To me, this is no less than an act of financial war, which, utilizing a poker term, could be considered the ultimate bluff, in that the fate of hundreds of millions, his purchasing power is at stake. As noted earlier, it was frankly laughable that anyone took the supposed Greek proposal seriously, particularly when both the ECB and Bundesbank immediately rejected it, although not as laughable as the PPT's blatant attempt to goose financial markets as a result, so the MSM would write articles of how the talks were going well. Well, they're decidedly not, and if you think yesterday's across-the-board Standard & Poor's downgrade of major European banks, in some cases to barely above junk status, was bad, just wait until fears of the default of hundreds of billions of Greek debt engulf the world like Ebola. Frankly, I'd be shocked if a single Greek still has funds in institutions like the National Bank of Greece by week's end, as clearly the aforementioned emergency weekend decisions may well be required in short order. And equally shocked if any European isn't considering the withdrawal of funds from the insolvent European banking system, which not only is starting to pay negative interest rates, but has a Cyprus-style bail-in template in place. And still more shocked if Europeans and citizens the world round, as in Turkey, where the lira hit an all-time low today, don't shortly stampede out of their dying currency war-afflicted fiat currencies into the safety of history's only real money, gold and silver. And sadly, perhaps 99% of the world won't ever get the chance, partly because they're too poor to do so, and equally because those that aren't will shortly realize just how little available for sale metal is out there. To that end, if you decide to take action while you still can by buying or storing precious metals, we hope you'll give Miles Franklin a call at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com.